What's going on, everybody? It's Spencer from Gray Capital, and unless you've been living under a rock the past week, there was a major election in the state of Georgia, and the Democrats were surprisingly able to take both seats, tipping the balance of power at the federal government in the favor of the Democrats. That means the Democrats are controlling not only the presidency, the House of Representatives, but the Senate as well, with Vice President Kamala Harris making that tie-breaking position at 51-50. Now, frankly, very few individuals a couple weeks ago thought the Democrats were able to get both seats. At best, they thought they were going to be able to get one seat in the Senate, still dealing with divided government, with Republicans maintaining control of the Senate, Democrats maintaining control of the House, and obviously with Joe Biden coming in as the new president here in the next week or so. But now the Democrats do have control of the Senate, the game for 2020 through the next few years has completely changed. Now, with the control of the Senate, certain agenda items that would not have been able to pass with the Republicans in control now can get through on a narrow margin. But what is likely to happen, what's unlikely to happen, and how is that going to affect real estate and specifically the multifamily market? Now, we don't believe that this is going to dramatically affect the multifamily market for the downside. In fact, there's a lot of positives as well as some negatives. But it's critical that we get into the details, understand where the landscape is going, and we don't know. And at the end of the day, worst case scenario, any new administration, even if they have control of the entire government, the House, the Senate, and the presidency, not including the Supreme Court, they can only get so much stuff done. That's just how it works. Usually one big package. So what's likely to happen? First off, likely things to happen are taxes are going to go up and spending is going to go up. And a result, especially of the spending, is we're likely to see higher inflation. Let's get into some of the specifics. We are likely to see increased rates on personal income in the higher brackets. Some of the top rates were reduced under the Tax and Jobs Act in 2018 through Donald Trump and the Republicans. We're likely to see some of those rates go up. We could also see the corporate tax rate increase from the 21% that it was reduced to back to 28%. We could also see capital gains taxes increase. Some have talked about them going to actual ordinary income rates, which would really be negative for the investment community, but more likely they'll probably go up 5 percentage points or so. It's also possible we could see increases to the payroll tax, as well as a tax on carried interest or their promote. And that's very important to syndicators and operators and GPs in the multifamily industry, because a lot of the revenue that a GP receives is through carried interest or that promote. That's going to not only affect hedge funds, which is kind of the political nature of trying to ram on Wall Street and hedge funds, but it's just small private real estate operators who are receiving carried interest that are also going to get hit. So we're likely to see taxes to go up, and that's because there's going to be a lot of spending. Now, the deficit and the debt has been ballooning under President Trump, and it keeps expanding under each president. The one thing that Democrats and Republicans always agree on is spend, spend, spend. It doesn't matter who it is, spending is going to go up. It typically goes up just as much under Republicans as it does Democrats. But now with interest rates where they are, the fact that we are in a recession, we are likely to see extensive spending. And this is after we've spent trillions of dollars recently fighting the coronavirus pandemic. Reports are that another $1 trillion stimulus package could be released in the first month of the Biden administration to stimulate the economy and subsidize industries and interest of the Biden administration and the Democrats. Also, that's been suggested is a $100 billion affordable housing program. Now that would go to the construction of new affordable housing, not market rate, but affordable housing. And that certainly is needed since there is such little new supply of affordable housing. We're also going to see the chance of those $2,000 stimulus checks. They are very likely to happen. And in fact, there may be multiple rounds of stimulus checks going out to ordinary Americans. There's even been discussion of the Federal Reserve issuing some kind of digital currency to be delivered to Americans directly into new digital wallets. Now, I think we're a little bit far out from that, but anything is possible. We're also going to see more spending on healthcare, possibly infrastructure. And infrastructure is the big plan that could get done in the first year. More spending on childcare and more money for states and cities. So not all of that's going to get done. If I had to put my money on one thing, you would think it would be infrastructure, since it's been talked about so much and we're in quite a bit of need of infrastructure spending. But whatever spending happens, it's going to go right along with tax increases. So what else is going to change? There's going to be policy changes. We're going to see more regulations. We're going to probably see the opening of borders. We're going to see new trade agreements. And again, getting back to multifamily real estate, we may see some changes to HUD and FHA. Now, I don't have a problem with opening the borders. And in fact, we need population growth. We need new people to come to this country. And one of the few driving factors of population growth is migration, people moving to the United States. We saw migration and immigration drop off over the past few years, and we saw population growth decline. If you're a real estate investor, you know population growth is a critical driver of our industry, and so we need that population growth. The more people coming to this country, needing a place to live, that's an overall benefit for the economy and certainly the housing industry. So what is not going to happen? Things that get talked about a lot of fear-mongering, but the chances are just about at zero. There's been a lot of talk of getting rid of the 1031 exchange or the like-kind exchange. I just don't think this is possible. Certainly it could happen, but there are just as many Democrats that own real estate as Republicans, and we do not want to see the real estate industry getting tanked. I just do not think the 1031 exchange is going away. Second piece, the Green New Deal. There's just no chance in hell. There's just not enough consensus. There's more moving to the center on part of the Democrats and the Republicans. There is just not the support for the provisions in the Green New Deal. On that same token, full-on socialism, it's just not going to happen. We still essentially have divided government, with Republicans having 50 seats in the Senate, Republicans having most of the states. We're not going to see a full takeover and our country changing and turning into a complete socialist country. Certainly, we have seen government expand, and the role of the federal government has been growing since our founding. But I don't think we're going to be entering into a full-on communism here in the next couple of years. Now, one risk to the multifamily industry that I don't think is going to happen, but something we want to watch out for, is national rent control. Now, if you look at the cities and states that have underperformed during the coronavirus pandemic, it's those cities and states that have significant rent control and tenant-friendly laws and codes and statutes in their markets. In the markets where you can continue to rent, that you can, maintain your property rights. If somebody isn't paying that can pay, and again, we're not talking about people who've lost their jobs. We're talking about people who maybe still have a job, but are just refusing to pay their rent. In New York City, you can't kick those residents out. In states where we've been able to retain some property rights, where landlords have had reasonable options to deal with non-paying residents, those markets are doing exceptionally well. We're in Indianapolis. We've seen positive year-over-year rent growth. We haven't seen occupancy fall off, and overall things are relatively positive. So any kind of implementation of national rent control, it flies in the face of almost every economist who has really studied housing. And so I don't think that would be palatable to most of the nation. Certainly that can happen municipality, state by state. It's not going to happen overall for the broader country. So what does all this mean? More taxing, more spending, more regulations. Well, if we look back at periods, different presidencies, Republican and Democrat, it can be a little bit of a wash where the Democrats, technically, the economy has done a little bit better under Democratic control than Republican control. The bottom line, though, is politicians don't make the economy. Sure, they can affect some of the variables, they can affect the marginal tax rate, but it's entrepreneurs, it's individuals that drive an economy. And so if you're overly concerned that the Democrats are in control of the Senate and you can't invest right now, you're looking at things all wrong. There's always opportunities out there. It's your ability to discover those opportunities, understand the risks involved, and execute. Take some action. So things are changing, and let's try to make the best of it. Sure, me personally, I don't want to see my taxes go up. That's one of the reasons why I invest in real estate. We don't pay a whole lot of taxes because of the awesome benefits of depreciation, all the write-offs that you can do, which again, I don't believe are going to be going away anytime soon. But one thing that we really want to look out for is inflation. With all of the spending, like I said, trillions of dollars have already been spent. Our debt load has more than, we've added trillions of dollars in the past few years in debt. And at some point, the value of the dollar will decrease, and it's already weakened over the past several months. Inflation is going to tick up, asset prices will rise, while wages will be relatively stagnant. If you've allocated your capital towards real assets or equities, you're going to do very well. But if you're not invested in real assets or equities, you're going to be left behind. That's why we like to invest in multifamily real estate. There's a lot of other real assets. You can invest in a lot of different asset classes that are going to do well during a period of inflation. However, multifamily housing specifically is known as an excellent hedge against inflation, as you're constantly renewing leases and you can track the growth of rent and rent inflation at every new lease. At the end of the day, the future is unknown. We don't know if they're going to be able to get anything passed through Congress. They may be able to get passed more than we believe. I mean, the Capitol was just stormed the other day, and who thought that would ever happen? But what we have to do is understand what the possibilities are, what the upsides and the downsides are, and tailor our strategy and how we're going to move forward based on what we know and the best information we can gather and analyze. I encourage you, if you found this at all useful, please smash the subscribe button and the like button. Share this, tell your friends, and if you're interested in learning more about passive investing into multifamily real estate, I encourage you to give us a follow. Check out our website, graycapitalllc.com. We put out a great weekly newsletter, all kinds of good stuff. If you want to take the step, sign up for our investor club and start diversifying yourself into commercial real estate assets. Again, my name is Spencer Gray. I hope you enjoyed this video. Have a good one. Thanks.